All right, well, good afternoon, everyone. I'm just going to let people collect in from the waiting room in just one more moment before we get started. But thank you for joining us this Thursday afternoon for our presentation. Just going to give it one more moment. All right, awesome. Well, it looks like everybody has now connected with audio. So hello and welcome to today's webinar on the Public Service Loan Forgiveness Program. My name is Michael Good. I'm the Director of School Support here at the New York Charter Schools Association. We're really excited to be putting on this presentation today for all of you, as this is really a topic that I think is extremely timely. We have seen recent news, especially in the education world this year, about teacher retention issues, recruitment issues. How can we sort of promote our staff to stay in the field, to encourage new teachers to come down the pipeline? And then, of course, this issue of student loan and student loan debt is definitely in the news. Even this week, we've had some major headlines around a continuation of the pause of federal student loans. But we're really excited today to have some experts here discuss with us the federal student loan forgiveness program and can give some information to you as a school that can be very helpful as you're thinking about this as a retention tool, as an additional benefit that you can offer to your staff. So without further ado, I'm going to go ahead and introduce our two speakers today. We have with us Nick Watts and Jason DiLorenzo from PSLF Jobs. Jason DiLorenzo is the founder of PSLF Jobs. He's also the founder of Doctors Without Borders, a national student loan advisory and advocate for physicians who have managed over $2 billion in federal loan debt positions for PSLF. Nick Watts is also joining us today as a panelist, and we're really excited to have both of these experts speak to us about this program. So without further ado, let me turn things over to Jason for today's presentation.
Thank you so much, Michael. That's perfect introduction. Obviously, you did your homework on the student loan marketplace, knowing that something was announced this week that is generally good news for all student loan borrowers. In serving the medical community for the past now 12 years, just in the way of introduction, I've been speaking at medical school graduations or exit counseling since 2010 on this complex and evolving student loan marketplace to help identify best practices for student loan management. A lot of doctors and medical professionals work in nonprofit public service loan forgiveness qualified environments. And what we learned over time is that while medical schools did a pretty good job of educating their graduates on the nuances and the complexities of federal student loans, other graduate programs that were producing significant amounts of student loan debt, i.e. master's degrees for teachers, law graduates, and other, as we've seen student loan debt increase dramatically, exponentially over the past 10 to 20 years, we haven't seen the kind of help in an advocacy way for borrowers. And that's ultimately we want to bring to you guys and to your staff in the form of resources. And as Michael suggested, a lot of news in the media recently here that has really flipped the script on the narrative of the public service loan forgiveness program. I've been speaking on this topic for many years, and I'd like to say I knew this day was coming where billions of dollars of federal loan forgiveness would suddenly start to be granted. It's been exacerbated by this PSLF loan for the public service loan forgiveness overhaul that was announced last October. So I'm excited to share those updates with you guys. And as we talk about recruiting and retention in schools being a challenge, how this can move the needle for you in terms of both recruiting and retaining staff. I do want to make sure I answer your questions along the way here. So as Michael and Nick are joining us here, if questions pop up either in the chat or the QA function, we can save them till the end, but if you find that something is relevant to be answered in the moment, I really want to answer your questions as well as we go through this prepared content to make sure that you guys walk away with the information and the resources that you wanted from this discussion. We're a wealth of information here on this program. We want to make sure we get the right information to you because there is an expiration date on some of the benefits related to this PSLF overhaul. So in terms of an agenda here, we're going to walk through what exactly is the public service loan forgiveness program and how does it work. We're going to actually profile in a charter school or in a public school, what are the three types of student loan borrowers that exist within an organization? Who's PSLF, meaning public service loan forgiveness? I'll use that acronym throughout here. Qualified and who isn't. We want to talk about what the environment was like before they announced this recent overhaul, and now what it looks like afterwards and some of those deadlines. You probably are familiar with the employment certification form process. This is something that is not mandatory, but we believe that it's mandatory for people pursuing PSLF and that it should be done annually. So we'll talk about that process and how you can even proactively move this needle or move this forward for your staff in a way that might actually take some of the work or timeliness of it off of your desk. I'm going to share some utilization data with you. We'll talk about a calculator that's available to your staff and to you that will quickly help figure out if someone's a PSLF candidate or not. I'm going to walk through some teacher case studies, talk about how legislation is evolving. And when we first started talking with Michael months ago, we talked about offering NE charters members a benefit on some of our services. So we'll share that with you and, of course, answer questions along the way. Now, what's public service loan forgiveness? Hopefully you all at least know this by name. It's all over the media in recent, well, it's been all over the media in recent years. The coverage on it in 2019, 2018, 2020 was generally negative, and a lot of applicants were being denied public service loan forgiveness, even though they had felt like they were meeting a lot of the requirements. So I'm going to talk about why that's changed recently and how generous the forgiveness is becoming and the programs being administered now. But let's take a step back. What is public service loan forgiveness? This was a program that was created by Congress in 2007, the College Cost Reduction and Access Act of 2007. So it started in October of 2007. And ultimately, it was created to encourage individuals to work in public service roles. How it works is it grants tax-free loan forgiveness to an unlimited extent to anyone who works for 10 cumulative years in a qualifying organization full-time while meeting really 3 requirements. And I'll explain these simply before we get into some of the complexities of them. And as administrators for your student loan borrowers, we don't want you to get in the weeds on exactly what their student loan repayment strategy looks like. That is, we've seen that public service loan forgiveness as navigating this program, the requirement is that you meet these 3 specific requirements that we talk about. Most of those are incumbent on the borrower, but you guys can help in the form of proactively and in a timely way doing your part, which is certifying their employment and letting them know at key times when it's appropriate to do so. So let's talk about the 3 requirements first. The first requirement for public service loan forgiveness is you got to have the right kind of loans. I'm going to make this real simple in explaining this. In July of 2010, the federal government nationalized student loans. So if you went to an accredited school and got an undergrad degree, a master's degree, any accredited program, and you took out federal student loans, the U.S. Department of Education is your lender, the federal government. And then those loans are serviced by one of really 4 main loan servicers today. So direct federal student loans is what all student loan borrowers have as of July 1st, 2010 on through today, and no plans of that changing in the near term. If you have direct federal student loans, they're qualified for PSLF. You don't need to do anything with them. If you went to school before July of 2010, it is very possible or even likely that you were taking out what's called not direct loans. They're not from the Department of Education, but they're called FFEL loans, Family Federal Education loans. These are loans that also come in the form of Stafford loans and Grad Plus loans for grad students, but they came from a private lender. Think Sallie Mae or Citibank or Discover or Wells Fargo. And these loans are FFEL loans. They're not eligible for public service loan forgiveness unless they are consolidated to a direct federal student loan, which all of them are able to do through one simple consolidation process. And so older loans pre-July 2010, if they are FFEL, they can be consolidated to direct loans and become available. We'll hold that thought when we talk about the overhaul later, but you can have the FFEL loans and still qualify for public service loan forgiveness. There's just an action item required there. The second part, and all three of these things need to coexist. You need to have the right kind of loans, direct federal student loans, while you're in a qualifying repayment plan. Now, the income-driven repayment plans, there are 5 available today, are going to drive the most value for an individual borrower to maximize public service loan forgiveness. Well, when we get into the case studies, I'll show a little more about how these work. And suffice it to say, an income-driven repayment plan is just that. It bases your monthly student loan payments on a percentage of your discretionary income. It doesn't base them on how much debt you have. People that have higher levels of student loan debt are going to pay less than they'd normally have to pay and likely have a lot of loan forgiveness available. Again, we'll cover that in the case studies. But the qualifying repayment plans today are the income-driven repayment plans. For previous borrowers, what the overhaul did, and we'll cover this, is any repayment on a previous loan will now qualify for public service loan forgiveness. That is the more generous interpretation of PSLF that has affected 1 million borrowers here just since October. Again, I'll get into those details. And yes, there's this presentation is being recorded. You may want to go back to this for your own individual knowledge or resource or to share. And so we'll share the slides in the recording. But a qualifying repayment plan is any income-driven repayment plan, and then you must work full-time for a qualifying employer. It doesn't have to be the same qualifying employer. You could be recruiting someone or have someone that worked at another 501c3 PSLF qualified organization for 3 or 4 years, and then they come to you, and if they do 6 or 7 more years of employment there, then they'd get their cumulative 10-year public service loan forgiveness, and they'd want to maximize that by using the right income-driven repayment plan for those 6 to 7 years that they were with you. The employment does not need to be consecutive. You just need to complete the cumulative 10 years, and then PSLF loan forgiveness is available to you. And I want to talk about the definition of full-time here, because there's been some questions around that as well. And likely if you're filling out these employment certification forms for your staff, they'll be telling you they worked from June 1st, 2018 to May 31st, 2022, 4 years roughly of employment. And when they fill out the employment certification form, they're going to say, I worked full-time. And then you'll have to certify, did they work for you full-time? The PSLF program defines full-time as an average of 30 hours per week for at least 8 months in a given year, unless you as an employer has a different definition of that, of full-time for that individual or otherwise in your bylaws or in your employment agreement. Now, we've seen some in hospital systems, individuals who say have a doctor that is considered 0.9 FTE, but they're working roughly 40 hours per week. They are submitting those forms to state that you guys kind of control the narrative around, does someone work there full time or not? And the encouragement, I think, at this point with how the program is being interpreted is that if someone is working more than 30 hours per week, or at least that for at least 8 months in a given year, that you can also certify that they are working there full time. So if any questions come up about that specifically, I'm happy to jump in and answer them. We can also do that at the end. But again, the biggest points there are the full-time requirement is a rather loose one, 30 hours per week for at least 8 months a given year, presumably to accommodate the schedule of a teacher. And then those payments do not need to be consecutive, nor do they need to be with one specific employer. It can be, and it likely will be, with a number of employers as the doctor progresses through residency and fellowship and then practice. That's at least 3 different jobs. And so we understand that it doesn't need to be all 10 years, although it would be nice if it were that when it comes to recruiting and retaining valuable staff. So the loan types that people have today, I just want to explain this. And again, we don't want to get too granular into the loan nuances, but federal student loans are pretty simple these days and have been for the past 12 years. They come in the form of Stafford loans or Grad Plus loans, and they come from the Department of Education. Now, the FFEL loans I mentioned, again, are standalone, not eligible for PSLF. They can be consolidated to a direct federal student loan and become eligible for PSLF. Another type of loan that you might see people have that can be contemplated in the PSLF trajectory would be a Perkins loan. That program ended back in 2017, but if someone has Perkins loans, they can also, like a FFEL loan, be consolidated into direct federal student loans and be eligible for public service loan forgiveness. If an individual has a private loan, whether that be from an educational institution, a bank, credit union, important to understand that a separate repayment strategy needs to be developed there. Those loans cannot be consolidated into a direct student loan or considered for public service loan forgiveness. So we're really talking about federal or FFEL or Perkins loans being the core loans that are available for public service loan forgiveness. I'll share this decision tree with you. I won't get into the granular details of it here. This is more for specific borrowers, but suffice it to say, it can be confusing for an individual borrower to try to navigate through the income-driven repayment plans. That's probably the greatest challenge, where the least amount of resources from loan servicers or lenders are available, and which is why, as advocates for borrowers and qualified employers, we've tried to put together a decision tree to help borrowers understand. Of the 5 income-driven repayment plans that are out there, I'll spit them off by name, but again, we don't have to go into the details. It's income-based repayment, income contingent repayment, revised pay-as-you-earn, and what's called a new income-based repayment plan. Most of your graduates are going to be choosing, most of your staff with student loan debt, if they're using an income-driven plan, are going to be choosing between either revised pay-as-you-earn or pay-as-you-earn and potentially income-based repayment. Those should be the really 3 names. Those are the most beneficial based on someone's profile. And if they're single, they're almost always going to be using the revised pay-as-you-earn plan. The short reason, the short answer for why that's most appropriate is because it has the lowest required payment. And also, when your payments aren't covering all of your outstanding interest, only half of that interest is charged to you. So you get the benefit of forgiveness. And if that's ultimately not the path, you also get less outstanding accrued interest. The greater decisioning comes when the individual is married and they have a spouse who earns more than $20,000 per year. If that spouse does not have federal student loan debt, it may make sense for them to use an income-driven repayment plan that allows them to base their monthly student loan payments on their own income and not their household income. If you think about someone that earns $50,000 a year or $60,000 a year and then has a spouse that earns the same, if you're able to base your payments on your own income, those payments can be between $100 and $250 per month. Whereas if you were to use the household income, payments get closer to $600-700 per month. A big difference there if you're trying to keep the payments as low as possible to maximize loan forgiveness. So this decision tree can help in choosing the right income-driven repayment plan. I don't want to confuse you too much with those details in helping your staff. You're not expected to answer those questions, but providing resources can be helpful. Let's talk about qualified employers here. The presumption here, and the reason we're doing this discussion, is because we understand that you guys are all qualifying employers. How this works in terms of qualified employers, the PSLF definition is actually broader than a lot of people think. If you work for any federal, state, or local government or agency directly, you're PSLF qualified. There's about 22 million of those jobs in the United States. And then 501c3 employers also qualify if they're employing you directly. If you have part-time employees, as we defined earlier, or you're contracting with someone, if someone is a 1099 or self-employed and you're paying them through a contract relationship or through a 1099, they would not be qualified for PSLF under the letter of the law today. It depends on where your paycheck comes from to qualify you. And here's an interesting factoid that I hope will move the needle on how you promote jobs currently, whether you do it through us or on your own. But only about 7% of qualified employers today are listing PSLF as a benefit of working there. We believe that should be 100% of employers. And while we understand that the coverage around the denial of PSLF may have caused some hesitation or trepidation around employers doing that, now with the interpretation of PSLF being broader and more cases being forgiven, being yes is we're seeing as the answer, and even refunds being given to people. Now's the time to be promoting PSLF as a benefit of working for you when you're posting jobs. So let's talk about your staff specifically and who's PSLF eligible versus who's not. First of all, we know that everybody has to have the qualifying loans. We also know that people have to make income-driven repayment plan payments. And so if you have to pay based on your income for up to 10 years, depending on how many years you have left, it may be possible that in an income-driven repayment plan, you're going to pay all your debt back over 10 years, and you really actually should not be pursuing public service loan forgiveness. So the first component that we'll talk about in terms of staff public service loan forgiveness profiles is anybody that has federal student loans that has what we'll call, and is favorable for economic reasons, a favorable debt to income ratio. These are borrowers that have less than, say, $25,000 or $30,000 of total federal student loan debt. When I run the analysis of how much someone's going to have to pay in an income-driven repayment plan based on their salary for the next 10 years, it's almost always going to be at least $25,000 or $30,000. And so if you have that much debt or less, it probably doesn't make sense for you to be pursuing public service loan forgiveness unless you've got a particular situation where your income is a lot lower, or your family size is so large that the monthly payments in an income-driven repayment plan, because they're based on discretionary income, are requiring that you pay practically nothing. So these individuals that have a favorable debt to income ratio are not eligible for PSLF, even though they may meet the 3 qualifying requirements, if that makes sense. The biggest thing that we wanted to identify now during this PSLF waiver or overhaul period is you've got people working for you that are eligible for this program and completely unaware. Those debt levels tend to start around $25,000 to $30,000 and go on up to, I know, Nick, we've worked on a bunch of these cases before. People that have $200,000 of student loan debt are already using an income-driven repayment plan because that's the best plan for them in terms of needing payment relief, but still wanting to reduce accruing interest and have some skin in the game with their payments. These individuals also qualify for public service loan forgiveness, and in some cases don't know it. So they have direct loans, they're in an income-driven repayment plan, or because of the overhaul now they have FFEL loans, and they might be using an income-driven repayment plan or have used any repayment plan over the past 15 or less years, and they have time towards PSLF and they don't know it. We want to identify all those folks for you sooner than later. And then you've got the folks that are already pursuing PSLF. These are going to be the people that are bringing you their employment certification forms. Hopefully they're doing that on an annual basis. That's not mandatory, but in terms of keeping this documented with the Department of Education, it's something that should be done once a year. And you can control that by reaching out to your staff and saying, this is when we're going to be filling out the PSLF employment certification forms for you. And so eligible and pursuing would be the third component of staff profiles. We talked a little bit about the public service loan forgiveness challenges being, we'll get right to the exact reason why in 2018 and 19, so many people were being denied. In 2007, this program was created. So if you fast forward 10 years, in 2017, the marketplace started asking, okay, let's see all this loan forgiveness. Most people, as we said, didn't have direct federal student loans. Someone would have had to tell them to consolidate their federal student, their FFEL loans to the direct loans program to then have payments that can qualify for PSLF. So between 2007 and 2010, before the nationalization of federal student loans, the majority of borrowers had FFEL loans, and the loan servicers, quite frankly, were not incented in any way, shape, or form to tell you to consolidate, because then they lost business. And that's why you're seeing program like the Consumer Financial Protection Bureau and other entities federally, punishing and otherwise investigating these loan servicers who were misleading people in many cases because they were incented to not let people move their loans over to direct. So we had that loan servicing issue happening for many years. The way the government fixed this problem is by creating an overhaul of the PSLF program so that earlier users of this program, or people that thought they were qualifying for public service loan forgiveness, can still qualify, but there's an expiration date on what they need to do to make sure that their previously not qualified payments or loans now qualify. So what the overhaul did was say, and this is not true going forward. So the three requirements for PSLF: you have to have direct loans, you have to be in a qualifying repayment plan, and you need to work full-time for a qualifying employer. From now forward, those are the requirements. The overhaul is a retroactive look back to say, if you have FFEL loans and you were making payments on them, but for some reason didn't consolidate to direct, whether it was your own loan servicer's fault or through some fault of your own, the school didn't tell you when you were graduating, you can now consolidate the loans to direct, and your previous payments will be counted towards public service loan forgiveness. But this waiver period expires October 31st of this year. So past payments on previously non-qualified FFEL loans and Perkins loans now count. And even if you did some sort of previous loan consolidation, which previously would have reset your clock towards the 10 years required, now that previous time does count. So who needs to take action here? Who needs to consolidate their loans? Anyone who still has those FFEL loans or Perkins loans, they're going to want to do their consolidation through the federal government's studentaid.gov PSLF help tool. That is the place for this. That we'll put the link in here as well, so that you can share that with your staff as appropriate if they don't already know that. But they need to complete a consolidation and choose a qualifying repayment plan, i.e. an income-driven repayment plan, on or before October 31st of this year. Our advice is to just do it now. It takes a few weeks to a month or two to process this stuff because there's a lot of activity right now, but fortunately no one's in repayment. So all the servicers are really doing in terms of administration is this right now. They're not administering, payment requirements, because that's been halted by the CARES Act. And as you mentioned earlier, Michael, extended through September 1st of this year. Another bit of good news on that is that the CARES Act payment and interest halt also counts as time towards public service loan forgiveness. So people are paying zero right now, yet moving closer to this forgiveness period, therefore leaving more debt outstanding, which is more valuable to them in terms of if they're PSLF eligible. The time you spent making zero payments, moving you closer to forgiveness, is going to get more debt forgiven, tax-free for you. Now, the employment certification process is one we've talked about. I presume that some of you are going to be, if not all of you, are familiar with this form. The best way to complete this form is to have the individual borrower go through and certify through the PSLF help tool. This pre-populates the form. And so the only parts that need to be filled out by the borrower is really to sign it once they complete their part. And then for you, employer, to confirm that they did work in a full-time capacity from the dates that are referenced in the form that they filled out when they completed the PSLF help tool. And then you sign that form. They then send it back to Fed Loans, is the servicer that's managing public service loan forgiveness. They ultimately gets tracked by the Department of Education, but they can either fax that form or upload it to their loan servicer's website after you fill it out. And then in roughly a couple weeks to a month, they'll get a report back that says they've made X number of qualifying payments towards the 10 years required, the 120 monthly payments, AKA 10 years. And so that should be the process that they're following. I know that's the part that you guys are probably most familiar with, so I'll pause to see if there are any questions on that specifically. I don't know, Nick, if you want to check the chat or Q&A field to see if any questions have come up.
Yeah, Maureen just asked, is this overhaul only for those that didn't consolidate? Are individuals who are making payments but not on an income-driven plan eligible?
Yes, borrowers who were not on an income-driven repayment plan previously, moving forward, they do need to be on an income-driven repayment plan. Those payments would count towards PSLF. We're seeing folks that were in repayment since 2007 or 2008 that still have loan balances, get those balances wiped away completely tax-free. That's of the 100,000 people and $7 billion of federal student loan debt, that's been completely wiped away. There's $131 billion of PSLF student loan debt in the queue right now for 1.3 million borrowers, but people have gotten immediate forgiveness based on that profile or question that you've just asked. What the thing that they have to do, there is no review triggered by the Department of Education other than, and you may have people that used to work for you that are coming back to you saying, certify my employment from 2012 to 2016 or something like that. Reason they're doing that is because they are also trying to get time counted towards PSLF that previously didn't count. And they could have been in any type of repayment plan. The government keeps all of that data. Was your status in forbearance or repayment? And for any years that you were in repayment on an FFEL loan, Perkins, or direct student loan, they're counting now, but all that ends October 31st. So if they still have those FFEL loans or PSLF loans, or Perkins loans that haven't been consolidated, or they previously didn't get an employment certification form because they thought that didn't count, now they want to do that. Nothing's going to trigger the review without that completed employment certification form. So that's the part that the individual staff member or borrower needs to know, that I'm not going to just automatically get my previous years counted. I've got to fill out a form that says I worked from 2012 to 2016. That'll trigger the review. And right now, those are being, as long as you were in repayment, they're taking 4 years and counting it towards the 10 required. That will move a lot of borrowers, the needle for them towards, in often cases, significant loan forgiveness. So this is what that, yeah, go for it.
Where can we find information to consolidate their loans in case a staff member asks?
studentaid.gov/PSLF. It's you can see it right here on the, we also have a link to it, I think, later in these slides, but you can type it in the chat field. studentaid.gov/PSLF is the PSLF help tool that will walk people through. All three components of PSLF are featured in here. You certify your employment annually. Once you're in a qualifying environment, working full-time for a qualifying environment, it'll help you identify if you have FFEL or Perkins loans, if you don't know the answer to that question, and allow you to consolidate just those. And then the employment certification form, that'll go to your employer so you can complete previous retroactive time under the waiver. Want to make sure everyone's doing that. And then you have to use an income-driven repayment plan separately. That's really the borrower's responsibility, not yours. Once a year, they need to renew that. They'll have to provide updated income information. None of that's happening right now because we've been in the CARES Act forbearance, which counts towards PSLF but requires 0 payments. Presumably, your staff are going to be required to go back into a qualifying repayment plan in 2023, sometime in 2023 is when we expect it. And so you want them to be prepared for that as well, because if they're in the wrong kind of repayment plan, if they're paying over 10 years or they're doing forbearance, they're not going to have that time count towards PSLF anymore. They need to be in they need to be in an income-driven repayment plan. And from our vantage, the right one to maximize their savings. So the PSLF help tool, what the borrower does before the form gets to you is they log in with their federal student aid ID. It asks them the questions appropriate. You as an employer should already be in that database. If for some reason you're not, that will also be identified, and what you want to do when you send someone to PSLF, the studentaid.gov/PSLF website, make sure you give them your EIN, your employer identification number, because if they have to scramble to get that, they're going to come back to you. And that we've seen that hold. I mean, how many times has that held you up, Nick? When, helping somebody through the
Number
tool.
of times.
So yep. So make sure you're sharing your EIN number with them if you know they're going to be going through that tool. In terms of PSLF utilization, we've got now, like I said, it's about 1.3 million borrowers that are actively navigating this program, meaning they've completed some of the required 10 years towards public service loan forgiveness. They've gotten qualified payments approved by the Department of Education. The average student loan balance for people that are pursuing PSLF is about $99,000. We know that teachers with master's degrees have on average about $80,000 to $100,000 of federal student loan debt. That makes most PSLF candidates for some level of savings. Again, you make payments based on your income, not how much debt you have. So the more debt you have, the greater the savings, the greater benefit you have working for a qualifying entity than not. And now we're seeing unique borrowers with loans discharged in excess of 100,000. But if we know that there's 1.3 million people in the queue and we average that out over the next 10 years, you're talking about over 100,000 borrowers per year being forgiven completely, and that representing about $12 to $13 billion per year, which is why I say what's happened with the overall here is really just a drop in the bucket compared to what's coming down the road for the next 10 years. And you want to make sure your staff, your borrowers are taking advantage of this. So let's take a look at some numbers here, but I'll hit the brakes on that part of the content just to see if there's any other questions about employment certification or the help tool or anything there. Okay, let's take a teacher's degree with a teacher with a master's degree who has $95,000 of federal student loan debt, roughly the average of a PSLF participant. Let's say they finished their undergrad in 2006 with $15,000 of student loan debt, Stafford loans, and then they went and got a master's degree more recently and borrowed $80,000. So their 10-year standard repayment plan, were we not in the CARES Act forbearance right now, would be $1,100 per month. If they have a family and they're earning a $55,000 salary, let's face it, they're not paying $1,100 per month. So the benefit now with CARES is that they're paying zero, but this time counts towards PSLF. Let's say this individual has been working full-time in a qualifying environment for the past 2 years. We have a calculator. We'll show you guys this calculator, but by entering this basic information, how much debt they have, what type of loan it is, FEL versus direct, and what their payments would be projected to be for the X number of years until they'd be they've completed the 10 years required for PSLF. The estimated savings in this case is about $90,000 out of pocket, right? This savings equates to them of about a $14,000 effective increase in their salary on average annually for the next 8 years. Now, how that plays out is because, we would estimate that their payments would be somewhere between $300 and $350 a month based on their salary. If their family size was larger, that would get us to be a smaller payment. So that certainly compares favorably to $1,100 a month, which was maybe even untenable. And we estimate that after 96 payments, that's 8 years, 12 monthly payments for 8 years, they're coming out of pocket $38,000. And the debt cost of $95,000 of student loan debt with 6% interest rates, that would cost about $130,000 to pay back. So this delta is ultimately what's being saved. by that individual. And when you average that out, because you make student loan payments with after-tax earnings, then the effective salary for this individual is really not $55,000 per year. If you were to compare it to a private sector job, it's really like making $69,000 per year for the next 8 years. Because in a private sector job, you're not saving the $90,000. You have to pay your student loan debt back. So these are the calculations we want to make sure borrowers have access to, so that they know what repayment plan they should be in, or if PSLF is appropriate for them. In this case, our calculator shows that they took out some loans in 2006. Those are FFEL loans. So of their outstanding federal student loan debt, 95,000 is outstanding, but 80,000 is direct. So they have until October 31st of this year to consolidate those at studentaid.gov. Whoops. But we recommend always taking immediate action to consolidate the student loans. Don't wait till October of this year if you know the benefit is available to you now. So the PSLF help tool would help them consolidate that $15,000 of loans that currently isn't qualified. Then they would do the employment certification form saying that they worked for a qualifying employer, be that you or someone else, to then get the payments on those loans qualified towards the 120 months required. I want to take just a moment here to talk about the alternative to federal benefits that exist now, which is a private refinancing marketplace. The reason we have to talk about this is because there are companies out there like SoFi. There's a stadium named after them now in Southern California. We see commercials on TV for Credible and SoFi all the time. And these private lenders get information that your student loan borrowers have student loan debt, and they send them, solicitations and market to them that lower rates are available in the private marketplace. Borrowers need to know that when they refinance their federal student loans to a private lender, they're signing a new promissory note, and they're giving up all of the federal benefits that we've been spending this time talking about here. So anytime they're approached by a private lender to potentially take rates down from 6% to say 2.5% or 3%, because sometimes that is available in today's marketplace, though rates are going up, they're giving up all their federal benefits. And so if someone has a PSLF opportunity to pay back way less than what they borrowed and get tax-free loan forgiveness, they should decidedly not refinance their loans. And so coming through a PSLF calculator to help determine, hey, okay, your debt to income ratio is, if you make $100,000 a year and you have 30,000 in student loan debt, you're not a PSLF candidate. And you may want to lower your rate from 6 to 3% if that's available to you, and give up federal benefits. But in the case of borrowers who have unfavorable debt to income ratios or any PSLF savings available to them, they should not be refinancing their federal student loans. The reason I mention this is because these lenders are very transaction focused and not consultative, and don't so much, work for borrower advocacy. They seek the transactions. An update on the legislation here, and then we can talk about available services here and wrap things up in a timely manner. But the CARES Act took effect March 13th of 2020, now just over 2 years ago. It halted all interest that's accruing on federal student loans and halted all payments. People that were enrolled in ACH, they had their monthly payments coming out of their checking accounts on a monthly basis. That was all stopped. You'd have to voluntarily make student loan payments right now. And anybody who's a PSLF candidate or anybody with student loan debt working for you, they have free debt right now, and their time counts towards PSLF. It would be hard to make a case for them to be voluntarily making student loan payments when that debt is free right now. They will expected to go back into repayment. They will be expected to go back into repayment now. The extension has been to September 1st of this year. It would not shock me if they extended this again through the end of the year. A couple of chances to be, before the midterm elections to do some favorable things for borrowers, if that makes any sense. I was a little surprised that it was only 4 months, given that the midterm elections are coming up. But suffice it to say, I think by 2023, if not September 1st, all borrowers are going to have to go into repayment. And by October 31st of this year, all borrowers are going to need to make the right moves to get the overhaul benefit, which is, as we've been discussing here, extremely beneficial. Those that were in income-driven repayment plans will be expected to recertify their income and be in an income-driven repayment plan making payments at some point in 2023 as well. So it's important that everyone, again, I'm showing the federal government website here, which is the administrative component of navigating all of this, employment certification, consolidation. And so let's talk now about the member benefits here that we spoke with Michael about initially. We operate a jobs platform, and once we move away from expressing and sharing all of this, I'll actually show you guys a couple demos of this. But we operate a jobs platform where we're advertising jobs to student loan borrowers. We've actually gotten some coverage in national media outlets recently. With the media's interest in this topic right now, and us being the only PSLF jobs platform out there, we hope and expect that to continue. So we charge $50 to post individual jobs for 90 days on our jobs board. You can also post unlimited numbers of jobs and get access to our PSLF salary calculator, which I'll show you. That costs $95 monthly. And we offer webinars to individual staff. So if you want to, we try to limit these to 100 participants per webinar. So if you want to team up with a couple of other schools to get to this level of participation, we charge $400 to do an hour-long webinar to staff where we're teaching your staff all of the things that we're explaining here to you, answering questions live. We record these and make them available to you for 6 months. So we talk to the borrowers directly, answer their questions, and explain all this. Those cost $400 on our website, which I'll share that link with you as well. Using the coupon code NECharters20, you get 20% off of all of these services. And so as a member benefit for all of you, we're happy to offer this discount. I want to show you a couple of other tools that we also have available. We operate PSLF Jobs, which is the jobs board. We also have an employer consulting offering that we're happy to provide a demo of as well. This is if you are making currently or considering making student loan contributions to your staff as a recruiting and retention tool. We're seeing this as an increasingly common employee benefit in the employer world. And so if you're thinking about making contributions to student loan borrowers, there's a way to do this where it's not taxable to them. And so we have an enterprise offering that facilitates using or maximizing PSLF and an employer contribution model. So we'd be happy to talk to you about how that works as our enterprise offering. And then also we have a quick PSLF salary calculator, which I'll show you now. This is the discount here if I'm still sharing my screen. This is our jobs platform. And then specifically our PSLF quick salary calculator here, I'll show you. So I'll use my personal information here. I'm in Arizona, in case we didn't already say that. Let's say I have a current income of $55,000. I know, Nick, a number that we've used for teachers with master's degrees often is $120,000 in student loan debt. We know those rates are around 6%, sometimes even a little higher. Have you made any eligible payments towards public service loan forgiveness? Somebody doesn't know that answer, or they're just starting this trajectory and haven't made previous payments. They could say no. In this case, let's say we've got someone that's been working in a PSLF environment for 3 years. That's 36 qualifying monthly payments. Ideally, this is something that's been read back to them already by the Department of Education. And when they submit this information, did I do this backwards?
Better, 12,000.
If they have a favorable debt to income ratio, 55,000 in income and only 12,000 in student loan debt, you can see that would be a refinancing consideration, right? They're not going to be a PSLF candidate. If you're making $300 monthly payments on your debt, you're paying $12,000 back probably over 3 or 4 years, not 10 years. And so in this case, we're calculating a salary boost that if they've already done 3 years towards PSLF, their $55,000 salary with you versus the private sector is actually worth an additional $23,000 in a change in effective salary when we contemplate the loan savings that's available to them. And so this calculator is available to your staff for free. Now, if they want to register for a more detailed analysis, they can come into our PSLF calculator, which is part of the enterprise offering that we have as well. So I will pause there and see if there are any questions, or I don't know if Michael, based on hearing all of this, I know you knew a little bit about PSLF here, but we just went deep into the weeds. So happy to get your perspective here, anything you want to add to that. And then Nick, if there's anything you wanted to add based on, talking to some of the borrowers and employers as we have over the couple of years since we started doing this.
Yeah, of course. They would definitely like to revisit this page that you just have left open, the coupon codes for the Northeast, New York Charter Association benefits. So thank you for having that. Michael, I'll let you respond in just a second, but I definitely wanted to get the attention of the people that are still in the room that this overhaul period is a very unique opportunity for the next 6 months. I recently helped a local teacher from my hometown in Florida. My mom's a reading recovery teacher. That's why education is so close to my heart, and trying to bring this debt forgiveness to educators around the country. He saved over $40,000 almost overnight. He'd worked 10 years for Sarasota County School District. He was previously assumed ineligible because he was in the wrong repayment plan for so many years. This overhaul is waiving that opportunity, and if you file correctly, you will be able to achieve this loan forgiveness if you work 10 years and you set yourself up. If you haven't worked 10 years, you have the opportunity to get on track. I know as educators, you have a finite period over the next 6 months because 3 of those months are filled up by summer. And you have probably a really hard time to get in touch with your staff members. So you have the next 2 months, and then you have the following couple months going into the fall to hound this into your staff, to file ECFs, to come on and do this salary calculator, as well as connect with us to do a staff webinar. We implore you, it's really important. You are going to be saving your staff members tens of thousands and sometimes more in savings for this opportunity. So thank you very much for joining, and we'll definitely get some insight from Michael here as well.
I should also let you guys know that we have a mailing list. Welcome to get on the mailing. And Michael, when I'm sending out updates, you'll get them as well. You're welcome to share them with the network as a resource. We also write a blog here, which is specific to PSLF. That's our mission here. So a lot of what we've covered in terms of the requirements for participating in the overhaul are listed here.
Well,
also, this is something there was one thing we didn't mention, which is any of your staff who's gotten teacher loan forgiveness or applied for teacher loan forgiveness. You may be aware that there's a program called Teacher Loan Forgiveness that if you work in a qualifying environment for 5 years, you can get either $5,000 of loan repayment or $17,500 of loan repayment. And the letter of the law stated that if you got that loan forgiveness, you wouldn't be allowed to use that time also towards PSLF. The waiver eliminated that. You can now, if you've gotten teacher loan forgiveness, you can now go back and recertify that employment, and it will count as 5 years towards PSLF. That could probably move the needle for a lot of borrowers who have gotten that. So that should be a bullet point here in the overhaul for teachers specifically, but I'll make sure we follow up with you on that, Michael, as well. that time now does count towards PSLF. We were previous to that telling people to apply for PSLF anyway, because there wasn't a lot of communication between those two. But it's nice to see that now that they've removed that that barrier.
Well, thank you, Jason. Thank you, Nick, for joining us today. I do want to provide one opportunity or one last call to the group. If there's any outstanding questions, feel free to add them into the chat or come off mute. But I know we're coming to the top of the hour here, so feel free once again to add those questions in as we do our wrap up. But thank you, Jason. Thank you, Nick. This is really informative information. And I think it's coming at the right time in the school year when we're having those retention conversations, when we're having a lot of recruitment fairs and conversations with prospective staff members, to know that this is a potential benefit when you think about the total compensation package of working for your school.
Absolutely.
So with that said, I just want to talk to our participants here. If this is the type of webinars that are of interest, we have a couple additional webinars coming up on various topics over the next couple of weeks. Next week, in fact, on April 13th, we have a webinar on the employee retention credit. This could be a webinar for your finance teams who might be interested in learning more about how this tax credit can actually help return to your school a tax refund for your payroll tax payments. I'm going to put the link to that webinar if you'd like to register for that into the chat, as well as our monthly statewide webinar, which is next week on the 12th at 4 p.m. Finally, for those of you who are operations leaders at your school, we do have our operations working group meeting tomorrow at 10 a.m. This topic of teacher retention and staff recruitment is going to be our focus tomorrow during our operations working group session. So please feel free to join me for that. And then lastly, as was mentioned in the chat, we are going to be dropping the recording for this session, as well as for the PowerPoint in our resource center. I'm going to make a link to that resource center in just a moment. If you join our resource center, which is the link at the bottom, just navigate to topics and then webinars, and you'll find the post for today's session. That's where you'll find the resources, both this PowerPoint as well as the recording. Thank you so much for joining us, and we wish you the best for the rest of your day. If you have any other questions, always feel free to reach out to me. I'm going to put my email in the chat.
Thanks. And thanks again, Michael. This is, we commend you on providing this kind of resource for your members, and we hope that it moves the needle in terms of taking advantage of this opportunity, whether you work with us or you just make sure that your staff know about it and follow the right steps to action.
Thank you so much.
Yep. Bye-bye.